Hi, it's me, Lucas Roth, CFA, CPA, and Realtor. I'm here to help you make money in real estate. So what we're doing today is we're just sharpening our saw, as they say. We're refining the skills that we have to, look at, understand, and value properties. Because it all comes down to that. When you make money, it's because you've underwritten a property correctly and you've paid a good price for it, and it's going to make you money into the future. You can only make those decisions if you're really confident about your approach to the properties and your valuations of them. So we're going to calculate net operating income today, okay? I'm going to write it out for you. Net operating income, the very first just thing you need to know is it ignores financing, okay? I got to write that up on the board because that's the first mistake most people make. All right, so first question is people say, well, why would I ignore financing? Because financing is a cost to me and I'm an investor and I account for all my costs. I'm not saying don't account for your financing. I'm just saying it doesn't belong here. When you calculate net operating income, there is no financing in this. If you want to include your financing costs, you include it in a different calculation, okay? And there's many other ways to value property, but you got to know this one. So ignore financing, and just so you understand, a property's value exists independent of you, right? So the reason why I say that is because people think, well, if my financing is this or that, then the property isn't worth that much to me. And that might be true, but the property exists independent of you. So if your loan is 3% or your loan is 6%, the property still gets the rents it gets, it still has the expenses that it has, and it doesn't change just because your interest rate might be this or might be that. Okay, so that's just to get all on the same page. We don't care about financing when we're calculating NOI. Here's what we do care about. We care about all income. So the main driver of your income is your rents. But you're also going to have, a lot of properties will have some storage income, some garage, rent, or parking, or possibly, some coin operated laundry, things like that. All that matters, and we count all of it. That's all of your income. Operating expenses is all your expenses besides financing. So I'm going to list out the main obvious ones, okay? So these are all things that you have to pay for to keep your property running. If you are taking on any of the utilities, then the utilities are an ongoing cost to you. Property tax, insurance, maintenance and repairs, HOA dues, the management of the property if you have a property manager. If you don't have a property manager, you should probably include the cost of your own time in managing the property because your time is not free. So all of these get subtracted from the rents, and that will give you your NOI. So NOI, just to kind of wrap everything up, is a very cut and dried number. There shouldn't be arguments about NOI, okay? It's all of your operating expenses. So everything that keeps the property running is an expense. Everything that every income that the property is bringing in is an income. And then you simply subtract the expenses from the income to arrive at your NOI. So hopefully this video doesn't complicate it too much and makes it pretty clear for you. Thank you for tuning in. Hit like, hit subscribe, and I appreciate you watching.